In trading, most losses do not come from bad entries, but from misreading market structure and liquidity. Traders see a break, assume a reversal, and get trapped. Other times, price looks messy and directionless, even though a clear trend is still in control. Welcome back to the ComLucro channel. In this video, we will build a clean and objective way to understand market structure and market mechanics. You will learn how to identify valid breaks, changes of character, and the difference between major and minor swings. Once that foundation is clear, we will move into 3 practical scalping strategies and show how professional traders apply structure, liquidity, and supply and demand concepts to real execution on lower time frames. So, if you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let us start with market structure. When the market is moving in a clean uptrend and price keeps advancing, it consistently respects demand zones and breaks structure to the upside. Put simply, in classical terms, it prints higher highs and higher lows. Every time a structural level is broken, a fresh demand zone is automatically formed. This break of structure is only considered valid when a candle clearly breaks through and closes above the level. While a wick extending above the high shows that buyers managed to push price higher, it also signals an immediate rejection back into the range. This behavior often looks like a liquidity grab, where stop losses are triggered from traders who entered short after the prior rejection. If price produces another break with a strong full-bodied candle, this confirms a valid breakout. At that moment, we can define this level as the most recent high or low. As long as price holds above this area, the bullish bias remains intact and our focus stays on buy opportunities. However, if a clear reversal pattern appears, it may be reasonable to look for a short trade targeting this demand zone, since it still functions as solid support. But change in character takes place when price breaks and closes below this low. This indicates that buyer control is being challenged, and the market may be shifting structure into a potential downtrend. The same logic applies in a bearish environment. When the market is in a clean downtrend and price keeps pushing lower, it respects supply zones and breaks structure to the downside. In other words, it forms lower lows and lower highs. Each time a structural level is broken to the downside, a new supply zone is automatically created. As long as price stays below this swing high, the downtrend remains valid, and our interest is strictly on selling opportunities. Here is an example. This shows the recent price action of the euro-dollar on the 1-hour chart. You can observe how price respects lower highs and repeatedly breaks structure to the downside, forming a textbook downtrend. Structure levels, swing highs and lows, and potential trade ideas are all clearly visible. If you study a chart and struggle to determine who is in control, it is often better to skip that pair. The difficulty is that markets rarely move in such a perfect way. In less ideal trending conditions, price may break below higher lows and still continue upward, misleading traders into believing the uptrend has ended. These moves frequently occur to collect liquidity or to mitigate fair value gap zones. Here is an example of how an imperfect trending market can appear. At first glance, price may look messy and directionless, but in this video, we will show you a method that turns this unclear chart into a readable and structured trend. The key idea is that in imperfect trends, your focus must stay on the overall structure instead of reacting to every small break. Many of these short-term reversals are temporary and often exist only to trigger stop losses or collect liquidity from retail traders. The first concept we will cover is how to separate major swings from minor swings. When does a swing high or swing low carry real importance, and when is it considered weak? In an uptrend, major swing lows are the critical zones where breaks of structure originate. This level represents the highest price recently reached after taking a previous high, meaning the starting point of that impulsive move defines our major low. A change of character happens when price breaks below this specific level. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. Now here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. For example, this low cannot be defined as a major swing low until price delivers a confirmed break of structure. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it. As explained earlier, only after a valid break of structure can a level be labeled as a major swing. For that reason, this level becomes the major swing low, while the remaining ones are considered minor. A break below a minor swing low still signals a loss of bullish strength. If there is a strong justification, such as a reversal liquidity sweep, coming from a higher time frame key level, you may consider a short trade targeting the major swing low. This is because once price reaches this area, supply and demand come into conflict, and we often anticipate a reaction when price taps into this major low. Still, trading against the primary trend carries higher risk, as it increases the probability of being stopped out, essentially moving against the flow of the market. Now let us review the bearish case. The ability to separate major swings from minor ones allows you to correctly define market direction and identify real reversals. After price breaks the lowest recently traded level, the starting point of that impulsive move becomes our major high. On the euro-dollar 1-hour chart, we can observe 1, 2, and 3 moves breaking below this low, establishing a trend. The origin of this move is defined as the major high. As long as price stays below this level, the market remains in a downtrend. Let us continue the process of identifying major and minor swings. When price breaks through and forms a new low, we label the level where that break of structure started as the new major swing. If price only wicks with one candle below the recent low, this is not a valid break of structure and is therefore classified as a minor swing. A move above a minor swing does not signal a change in character. A real reversal only occurs when price breaks above the major high. We keep marking major and minor swing highs until a valid change of character appears, confirming a potential reversal and shifting our directional bias to bearish. In this example, we have a change of character defined by 2 clear wicks breaking above the last major swing high. However, it is important to emphasize that a change of character is only considered valid when either 2 or more wicks clearly exceed that level, or when a candle decisively closes beyond it. Then a break of structure must occur after this condition is met, confirming that the previous bearish structure has been invalidated. Another factor that strengthens the validity of a change of character is when the move is strong enough to break through the last 2 swings, not just one. If this does not happen, as in this case, the change of character is classified as a fake change of character. This was the first criterion for defining a major swing, the origin of a break of structure. There are 2 additional criteria that help us identify major swings and confirm market direction. The second criterion is the fair value gap. A bullish fair value gap represents a buy-side imbalance, where buying pressure clearly exceeds selling pressure, often linked to institutional activity. The demand zone that generates this gap becomes more significant, and we expect a reaction when price revisits this area from an imbalance perspective. Demand zones that include fair value gaps are treated as major swings, while those without imbalances are considered minor. When price breaks below a major swing that created an imbalance, it signals a meaningful shift in momentum and points to a potential reversal. The same concept applies to bearish scenarios. Here we have 3 price examples. The first one shows neither a break of structure nor an imbalance, so it is classified as a minor swing. A break below this level does not signal a change in momentum or a reversal. The second example is the origin of the breakout, but does not include an imbalance. For that reason, it is considered a major swing, but only with 1 star. The third example is both the origin of the breakout and the source of an imbalance, which makes it a major swing with 2 stars. Up to this point, we have covered two criteria that define a swing point as important and major. Before moving into the third and final criterion, let us examine a trading idea. Here, we have a major swing low that initiated this break of structure. We also see another swing that created an imbalance. This level is classified as a strong swing even though it did not cause a breakout. When price revisits this level, we expect a rejection. However, if price breaks below it, that signals bearish momentum. This situation often appears when price taps into a key level from a higher time frame. At this point, we can look for short entries inside this inverse fair value gap area, targeting the major swing low, since it continues to act as strong support for price. Now let us move to the third and final criterion that helps us define a major swing, the depth of the retracement. Consider this example of an upward impulsive leg. After the impulse, price forms two retracement candles, but this pullback does not reach the 38.2% Fibonacci retracement level. Because this minimum retracement is not achieved, this correction is considered invalid. As a result, this pullback does not qualify as a true swing. Instead of being treated as a completed move followed by a correction, the next push higher is considered a continuation of the same impulsive leg. In other words, both pushes are read as a single impulsive movement rather than two separate swings. This leads us to an important rule in the ComLucro framework. For a retracement to define a valid swing and separate impulsive legs, it must reach at least the 38.2% Fibonacci retracement of the prior impulse. If this condition is not met, the move is treated as one continuous impulse and cannot be used to define a major swing. Now take a look at these examples. In the first case, none of the criteria we covered are present, so this level is classified as a minor swing. In the second case, we have a break of structure and a valid retracement, but no imbalance. For that reason, it is labeled as a major swing with 2 out of 3 criteria met. It is important to note that the retracement reaches at least the 38.2% level, which makes the swing valid. In the next example, we see an imbalance and a valid retracement to 38.2% or more, but there is no valid break of structure, so this is also considered a major swing with 2 stars. In the final example, the swing has created an imbalance, broken structure, and shown a proper retracement. This makes it a major swing with 3 stars. Breaking below this low confirms a valid change of character, signaling a true shift in market direction and momentum, or however you prefer to define it. Up to this point, we have shown how to identify major swings and valid changes of character, and why not every break signals a real reversal. Liquidity sweeps and fair value gap mitigation can invalidate a change of character. When a major swing sits in a liquidity area, a break may only be a stop hunt, with smart money sweeping liquidity before continuing the trend. The same applies to fair value gaps. Price often breaks structure only to rebalance an imbalance, not to reverse. Now that you understand how market structure truly works, you can see why many scalping strategies fail when structure is misread. Not every break is a reversal. Not every wick matters. And not every move against the trend means control has changed. This structural clarity is what allows scalping to become precise instead of reactive. In the next section, we will apply this exact logic to real scalping execution. You will see how breaks of structure, changes of character, liquidity grabs, and fair value gaps work together to create high probability entries on lower timeframes. Before we begin, it's important to note that scalping strategies focus on short-term trades within lower time frames, especially during periods of high market liquidity. Because scalpers operate on these smaller time frames, they face more false signals and must manage risk with precision. It's also best to focus on major pairs with tighter spreads, since every pip counts when targeting moves of just 10 to 20 pips. Most trades are completed within an hour, making scalping perfect for traders who want quick results without spending too much time on the charts. So here's a quick checklist every scalper should review before analyzing the market and placing trades. Now let's move on to the first scalping strategy, In this setup, we use two time frames, the 30-minute and the 5-minute charts. On the higher time frame, we analyze the market structure to identify the overall direction. We look for breaks of structure, BOS, and changes of character, CHO, to confirm the trend. Then, we manually mark the fair value gaps, the zones that highlight the best areas to look for potential trades. Once price returns to those gaps, we switch to the lower time frame. On the 5-minute chart, we wait for a clear entry signal, typically when a liquidity grab pattern appears. After spotting that setup, we enter the trade and define our targets. This approach works because it combines three key elements: trading in line with the trend, taking entries from strong supply and demand zones, and using lower time frame confirmation for precision. Now, let me show you how this works directly on the price chart. In the first step, we identify the market direction by marking breakouts and changes of character, or BOS and CHOCH. These can easily be drawn manually using simple trend lines and labels to visualize structure shifts on the chart. Start by marking each break of structure that confirms trend continuation and each change of character that signals a possible reversal. These two elements form the foundation of market structure analysis. In this example, we can see the price breaking structures to the upside on the 30-minute chart. That means we're in an uptrend and should focus only on buying opportunities. Next, let's talk about fair value gaps. These are imbalances on the chart, zones where price moved so quickly that it left a gap between candles, creating an area of inefficiency. The market often returns to fill these gaps as it seeks balance. We'll use these manually marked gaps as key zones of interest, expecting possible price reactions when price revisits them. First, wait for the price to trade back into the gap, then move to the lower time frame to look for confirmation signals before entering a buy position. So, let's switch to the 5-minute chart. On this lower time frame, the goal is to spot signs of a possible reversal. One strong clue is a bullish liquidity grab, when price briefly wicks below a previous swing low before reversing upward. This move shows where stop losses were triggered, followed by a sharp reaction in the opposite direction. Liquidity grabs often occur near key zones like fair value gaps and can serve as powerful entry confirmations. When this move also breaks a recent bearish structure on the lower time frame, it gives us extra confirmation. In other words, it forms a change of character. Now it's time to execute the trade. Place your stop loss just below the low of the liquidity grab and set your target at the next key level identified on the higher time frame. In a bearish setup, start on the higher time frame by confirming a clear downtrend marked by lower lows and lower highs. Then, manually outline the fair value gaps as potential supply zones. When price retraces into one of these areas, move to the lower time frame and look for a bearish liquidity grab just above a recent swing high. Enter the trade once confirmation appears. Set your stop loss above the liquidity grab and aim for the next major support level below. Finally, always apply solid risk management to protect your capital. Stick to your plan and stay disciplined, avoiding emotional decisions. This strategy performs best in trending conditions, not in sideways or choppy markets. Keep learning and reviewing your trades to keep improving over time. Let's move on to the second scalping strategy. This setup has three main parts: a draw on liquidity, a liquidity grab, and the entry. So, what is a draw on liquidity? It simply means identifying a key liquidity level that price is moving toward. In other words, the market often moves toward areas with resting liquidity, such as equal highs, equal lows, or sharp reversal points, because that's where many orders are waiting to be filled. You can mark these levels manually by drawing lines across equal highs and equal lows, or by highlighting clear buy-side and sell-side liquidity zones on your chart. With that in mind, the first step is to locate a major high or low on the 30-minute chart that price is approaching. In this example, we have buy-side liquidity on the 30-minute chart, and price is being drawn upward toward it. We can anticipate that move, since liquidity tends to attract price. If a clear draw on liquidity isn't visible on the 30-minute chart, zoom into the 15-minute chart for more detail. Next, we look for a liquidity grab in the opposite direction of our draw on liquidity, this time on the 5-minute chart. So let's switch to the lower time frame. Keep in mind that in this case, the buy-side liquidity sits above us. At this point, we're looking for a swing low to be taken out, a sign that price may continue moving upward. You can enter the trade as soon as price returns inside that range. Alternatively, a more conservative approach is to wait for confirmation. Let price push higher to confirm the reversal. Then identify a manually marked fair value gap to set a buy limit. If no clear gap appears on the 5-minute chart, zoom into the 1-minute chart for greater precision. Let's quickly recap the bearish setup. In a bearish scenario, start by identifying a major liquidity area that price is moving toward, such as a previous low or a level packed with stop losses. These zones often attract price before a reversal occurs. Then, switch to the 5-minute chart and watch for price to move above a recent swing high before snapping back down. This action shows a liquidity grab, suggesting the market may start trending lower. Next, open a short position and place your stop loss above the high of the liquidity grab. Allow price enough room to move. Avoid keeping your stop too tight. For your target, aim for the next clear sell-side liquidity level. This keeps your trade structured and intentional. Now let's move on to the final scalping strategy, one that's completely based on pure price action. This method uses just a single time frame, and you can choose whichever best fits your trading style. First, identify the market direction to decide whether you're looking to buy or sell. Trading in the same direction as the dominant trend increases both confidence and consistency. What we want to see here is a clear trending environment. In an uptrend, price should form higher highs and higher lows while respecting the previous swing lows. In a downtrend, it should create lower lows and lower highs while respecting the swing highs. In the case of an uptrend, wait for price to form equal highs and then break above them. From basic price action principles, we know that when price revisits this breakout zone, previous supply turns into demand, meaning there's a stronger chance for price to bounce back upward. So we wait for a pullback into that zone and then look for confirmation before entering a trade. You can enter once a candle closes above the previous candle's high. That's your signal that the level is being respected. If there's no confirmation and price keeps falling, simply skip the setup. You can also zoom into a lower time frame to refine your entry. After price returns to your demand zone, switch to the lower time frame. You'll often notice a short-term bearish correction, which represents the pullback from the higher time frame. Draw a trend line across the wicks with the most touches and wait for price to break above it. Once that breakout occurs, you can open a long position. Place your stop loss below the swing low and set your first target at the swing high. This confirms that the short-term downtrend has ended and price is ready to continue upward, following the main bullish trend. Now let's look at the bearish version of this setup. In this case, the higher time frame shows a clear downtrend, with price consistently forming lower lows and lower highs. What we're looking for is an equal low followed by a clean breakout to the downside. When price pulls back to this breakout area, the previous demand zone now acts as supply, meaning there's a stronger chance that price will reject this level. For confirmation, wait for a candle to close below the previous candle's low. That's your signal that sellers remain in control and it's time to consider a short position. If that confirmation doesn't appear and price keeps rising, simply skip the trade and wait for the next setup. For a more precise entry, zoom into the 5-minute chart. You should see a small bullish correction, a short-term uptrend against the main downtrend. Draw a trend line across the lows of this move and wait for a break below it. Once it breaks, you can enter a short position, place your stop loss above the recent swing high, and set your first target at the previous swing low. This setup shows that the short-term pullback has ended and the price is ready to continue downward with the overall bearish trend. Keep in mind that you can always check the higher time frame to see where the price is positioned in the bigger picture and whether your analysis aligns with it. For example, if there's a key market structure level right in front of the price, there's a higher chance that the setup will fail. That's because when the price reaches this level, it's likely to get rejected by the market. So always check the higher time frame to make sure there's enough room for price to move in your direction before reaching the next key level. That simple habit keeps you aligned with the broader market flow and helps you avoid trades that run straight into major structure. Together, these 3 scalping strategies form a complete framework for trading with structure, precision, and confidence. Whether you prefer smart money concepts or pure price action, the real edge comes from consistency, following your plan, managing risk with discipline, and refining your execution through continuous practice and review. Over time, that's what turns a setup into a skill and a strategy into real trading mastery. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.